Good evening and welcome to another episode of Bond Squad's Bond Squad After Hours broadcast. This is June 3rd, 2015. Before we start our show, let's get the disclaimers out of the way. Bond Squad and Wealth Strategies and Management are separate entities from Private Advisor Group. Private Advisor Group is a registered advisor and our RIA, through which we conduct our portfolio and management business. And again, they're extremely supportive. Anybody ever looking to go independent, not that we're saying in a happy firms, but with the support with PAG is tremendous. And we couldn't have done what we did here with Bond Squad without them. So we're more than happy to sing their praises. Well, good evening, everyone. We are broadcasting tonight from the Bond Squad garage. The reason we're doing this broadcast from the garage because we're discussing jobs and work, and this is an active workshop. Besides being bond geeks, we here at Bond Squad also like to restore vehicles and other odds and ends. As you can see behind me, a collection of motorcycles. The newest one is the black and silver 1989 Suzuki Katana. That's my daily rider. I actually came into the office on that. The rest of them, the newest one is the purple 1979 Honda Hawk. Over to my right, we have my racing tires. And over here, my Shelby Dakota. Yes, that is an actual Shelby. Carroll Shelby only made them 1 year, 1989. He made two colors only, white and red. I actually had a red one too, but I sold it in finance. There's orange restoration. You can't really see the orange bike here, I don't think. Let's swing it down. Yeah, little orange one right there. You know, that engine was rebuilt from the crank up at 250. That makes about 33 horse. It'll run down bike steel with engines twice or three times the size, except for the super bikes, of course. But we're doing the broadcast here from the workshop because we want to discuss work and labor and how things change, how things are the same. And where the labor force might be going or not going, where jobs might be heading. You know, our shop here is a kind of microcosm of the transition between the old economy, new economy, old ways of doing things, new ways of doing things, old job market, new job market. For instance, in our shop, you can't see it, but over to the right, we have a workbench with a drill press, table saw, scroll saw, grinder. I mean, we fabricated parts of fenders for bikes, to our own tools to get into tight spaces. I have an engine on a stand over there, and I don't only have the car that would work with the engine, but I have an engine over there, you know, nonetheless. But at the same time, I'm broadcasting to you via wireless internet. We have broadband here in the workshop. So where we have a bike here, the oldest one, this black one here from 1970, we have a 1970 bike with carburetors and ignition points while we broadcast to you with state-of-the-art wireless internet, all right? So this is the transition where we're going. You know, nobody's making this stuff anymore. We have to rebuild them for people. We actually have a 1986 Suzuki Intruder over here that belongs to a friend of ours who had some health issues. You know, he was a Vietnam vet and all that. And he needs help getting the bike on the road. So we got it running. We're putting some of the finishing touches on it. You know, no, don't worry. It's not an outside activity. It's not a business. We're doing this for a friend. You know, that's what this is. This is, you know, not a business activity. This is kind of mental therapy for us. But this shop is the changing economy in microcosm. So what we're seeing now is a labor force which is smaller and might not rise as far as percentage of the economy goes, but we don't see the labor market falling apart. And with ADP out today and non-farm payrolls on Friday, you know, the talk has been, are we nearing full employment? We turn that around and say, are we getting near full staffing? And what's full staffing? Well, the point where businesses don't have to ramp up hiring because they have enough people and can ramp up productivity gains. Right now, you know, from our observations, and we're exampling this here in this shop, we can be much more productive than what we are. The technology out there is tremendous. I do most of this work myself. Sometimes my sons help me. and on my limited schedule. But because of modern technology, I can bring up manuals right here on the screen, schematics, order parts right from the shop without ever leaving and have it delivered next day by Amazon. I'm much, much more productive than I would have been just 10 and really 20 years ago. And so Bond Squad is wondering, we don't know, it's too early, it's just a theory, but are we at a point where the pace of hiring doesn't have to be higher or much higher than the growth in the working age population? Now, we saw some pretty lofty non-farm payrolls numbers late last year, prints over 300,000 jobs. But we've declined steadily since, and now we finally had an ADP report that went back over 200. It was 201 today. We were on the Estimize website, estimize.com. We were the second closest, right behind Bank of Montreal in our estimate. So we were at 195. They were at 200. 201 came out. Everybody else was either higher or lower. So we were right there. So our picking's been right there. So we're wondering, are we at a point where businesses don't really have to ramp up hiring? And that's coming back to earth. Now, the replacement number for job growth, and that's the amount of job growth that pretty much keeps up at the pace of the working age population. It's unknown exactly what it is, but most economists put it somewhere between 150 and 170 or 175,000 per month. And we're printing at 200, just over 200 last month. We're probably going to print just over 200 this month. We printed well below 200 back in March. So we might be to the point where hiring is settling, it's plateauing, it's finding its natural level. Water seeks its own level. Well, hiring will do that too. And we saw a little bit of that in the durable goods figures. We saw more capital goods spending. And there's an article in The Economist today where they cite Keynes and a few other economists where you get to the point where technology advances such that you don't need as many workers. And before you needed workers in different occupations, you needed both to meet production, especially as you elevated the middle class. But as The Economist points out, the middle class was really a 20th century happening. Where we go from here is unknown. So we think here at Bond Squad that we're going to print right around 205,000 jobs on Friday. We'll see wage growth somewhere in the low twos, unemployment rate, 5.4, maybe down to 5.3. But we're not confident that we can get below 5. Now, the Bloomberg survey of economists has the unemployment rate going down below 5%. I believe, if I remember right, in the third quarter of 16. That would be right around what the Fed thinks is full employment. We think it's even lower than that. And by full employment, we just mean the level where we get faster wage growth. But we're not so sure we can get to that point because we see a little bump up in wages. Bam, technology comes on. And you're starting to see that too. You're starting to see more firings announced recently. You're starting to see more automation coming. JP Morgan's going to lay 5,000 people off on the retail banking side, and quite openly said we're going to replace them with automation. We think that's going to continue, and that's going to hold wage growth down. So we don't see a recession, but we don't see this inflation. We don't see this rampant wage growth. In other words, this is fifth gear, guys. Just like that car is 5 years, it's in fifth. And we don't see it really picking up from there. Now, interestingly, we saw long-term rates spike higher today, and actually the past couple days, but today really spiked higher. 237 ended the day. It's opening up overnight trading soon. Should open right around 236. That's a far cry from the 210 it hit during the early morning hours yesterday. That's 27 basis points. On a 10-year Treasury. What? That's 2.5% move in price. That's a big move. All right, and now he's calling the global bond route. All right, guys, listen. No one in their right mind thought that I know of anyway, thought a 10-year below 2% was sustainable. I also don't think, and I have company with this, that a 10-year above 3% is really sustainable in this environment. Double Line's Jeff Gundlach stated we thought very well today when he says rates are probably going to go up, but not much higher. And that's what we see. So we have most of that wage gain. Maybe 2.5 is our peak here. We suggested starting to add duration a little bit when the 10-year broke 230, and we did that. We did that as well. But we're still holding cash on the side because we're counting on bad advice going out to the street and investors panicking. Sorry, guys, but investors will panic, and they'll see this as a secular rise in rates, and they'll sell their bonds and their bond funds, and and in an illiquid market, you can see some really sharp volatility. And the key is not to leap when you see that. As far as panicking goes, there are probably opportunities. If you're going to hold to maturity and you're going to clip coupons, you buy on the dip, right? You don't care where it trades in the interim. But people aren't conditioned that way anymore. And interestingly, the modern portfolio theory guys, are already starting to call for a rebalancing of accounts based on what's happening. Good, rebalance all you want. We'll just keep buying for income. If it's 18, we don't think it's going to be that bad, but we'll be able to pick up some bonds fairly cheaply, we think, on a risk to reward basis. Of course, suitability matters. So the question now becomes, why didn't the long end sell off the way it did? And this will get to our ECB discussion that we promised. It seemed to happen right around the time that the ECB, released its statement, and then even more so, at least today. Yesterday was on U.S. economic data and European economic data too. Some inflation finally. Yep, the headline is running at 0.3%, and core CPI in Europe is running at 0.9%, and so it's caused to raise the inflation flags. I mean, come on, give me a break, guys. But that started the whole thing, and it was kind of piling on when the ECB spoke again today. And you saw it with the German 10-year rising to just about 80 basis points, and it was at 48 basis points, this time last week. So that's a pretty sharp increase. Almost doubled in yield, right? So it kind of like, remember, these rates are tethered. Our long-term rates, the German Bund, the U.S. 10-year, they're kind of tethered. So they go up, lets us drift higher. But we think there's something else at work here. And again, Jeff Gundlach has hit on this several times, as have we, that if the Fed is going to tighten, or is believed going to tighten, that should lead to a flatter curve and long-term rates not moving a whole lot. If it looks like the Fed is going to kick out the time that is going to tighten, it could lead to a curve steeper and long-term rates moving a bit. What we're stopping that, we think, that the German 10-year was holding that down. So now the German 10-year is moving up, and it's not providing that downward drag on U.S. interest rates. Meanwhile, U.S. economic data has just been okay, all right? And now there's talk that the Fed might not tighten until December or even next year. Looking at the Beige Book, we see no reason to move our September forecast for the first rate hike out, but this forward. And if we are wrong, it's probably going to be because the Fed tightens December or early next year. That's what Jeff Gundlach thinks, that they're tightening 16. If we're wrong, he's probably going to be right. We think he has the market pegged. So if anybody likes double, it was one about double line, we think that Mr. Gundlach's head is in the right place, as opposed to some non-bond people trying to call the bond market where the head is in a very dark place. But that's another story. This is a family show. So we think that the Fed goes, but only goes once. And we think that this move in long-term rates might be a little bit of the bond vigilantes coming back here, saying, and also with the ECB saying, all right, you're committed to QE, ECB, you're going to be data dependent, Federal Reserve. What we're going to do, we're going to pop long-term rates in your face, and we're going to undo what you're doing and make you blink, right? Well, at least in the U.S., we believe that, again, Mr. Gundlach is right. The bond market wants the Fed to finally tighten. We want the Fed to tighten. We think the Fed should have began to tighten back in late 2013, never mind 2014. Not that things were so rosy then, but QE is running out. It's a more of diminishing returns, right? It's not doing what it did before. People aren't borrowing and spending except in autos, and we'll get to that too, because we think there's a bubble in auto loans. But we think that the Fed should start to normalize policy, if only to have ammunition to combat the next crisis, which we don't know when it's going to happen, and we don't know how severe it's going to be. But even Vice Chair Stanley Fischer said Eventually, we're going to have another crisis. We're going to have a downturn. The Fed needs some more ammunition than what it has. So we think for that reason, the Fed should do it. Plus, we're in an economy with an aging demographic and more consumers reliant on their interest income and dividends. Well, higher interest rates, moderately higher interest rates, would be a kind of a sweet spot because you can keep rates low enough to encourage borrowing from those who can and want to borrow, and you can push rates up a little bit higher, so those who are relying on income for their spending have a little bit more to spend. And there's a theory out there, and we think it's a good theory, that because rates are so low, consumers, especially older consumers, are saving more because they need more savings to generate the amount of income they need. You know, if your interest is lower, you have to have more principal to generate the same amount of interest income. So we think that might be going on out there too. So what we think we have going on here is a kind of, bond vigilantes coming back into the market saying, look, Fed, if you think about putting things off, we're going to jack long-term rates in your face. That's what the bond vigilantes did, if you remember right, back into the 1990s, when the Clinton administration, we're not getting political, this is just a fact of the bond market, was considering launching Hillary Care, kind of a socialized or a government-run, we'll say, healthcare plan, and that would involve more government spending and borrowing. Well, the bond market jacked long-term rates in the administration's face, causing Clinton advisor James Carville to say that he'd want to come back as the bond market in his next life, because if you're the bond market, you can intimidate anybody. So if you have a Fed there saying that, so we're gonna kick out the time longer until we start tightening. And the long end of the curve, the bond market just takes long-term rates up in the Fed's face. Well, how does the Fed combat that? The Fed has to become anti-inflationary, and that means lifting short-term rates, flattening the curve. It slows down borrowing. It theoretically takes inflation out, and you start crimping the rise and eventually halting the rise of long-term rates. So I think there's a little vigilanteism going on there. Now the question is, how is the bond market going to react to Friday's payrolls number? There's two ways of thinking of it. If the bond market is in fact pricing in stronger growth and inflation generated by consumption, then a positive non-farm payrolls number, let's say above 230 or above 235, or really 250, because we think 230, 235 is probably priced in. At least that amount's priced into today's bond market, and we'll explain in a second. That we could see long-term rates rise. But if we have a good number and the bond market stabilizes or long-term rates come low, that would indicate that the bond market thinks that the Fed is going to push, and that the Fed's going to push pull forward rather, or at least stay within 2015 rather, the time for tightening. Now, the contrary to that, if we have a really poor number, let's say below 215 or even below 200, you could see the bond market rally for that reason too, thinking that the economy is so weak that it can't generate any inflation. So we're looking for a sweet spot. So what do we think happens? Our forecast is for 205,000. It's probably a little low considering today's ADP of 201, because ADP is usually about 20 under non-farm payrolls. We also think there's some lag in there too. So we think 205 is the number for Friday for non-farm payrolls, and about 200 or so for private. And that's what we think we get. We would not be surprised if we saw a 175 print. We'd be mildly surprised if we saw a 250 print. There's a lot of noise, and there's a lot of seasonality in these numbers. There's a lot of summer hiring that happens in May. People are hired for their summer jobs in May a lot, and that can get really, really noisy. The data can get really noisy at that point. We think 205 sounds about right to us. We took on some duration. We think that the general trend in long-term rates is higher, to where the 10-year finishes 250, 260 this year. But we think that there's another run towards 220, maybe even 210. Here's why. The ECB does not want the euro to rally too much. It probably doesn't like it here around 212. It almost certainly doesn't like it around 215. And it probably wants to keep the German 10-year below 1%, if not below 3/4 at this point. So we think the ECB is going to put its money where its mouth is, and before the holidays start later in the summer, is going to come in and buy long-term European sovereign, especially the German Bund. Now, liquidity is non-existent. This is our idea of liquidity. It's our all-purpose cleaner. There's more liquidity in this bottle than there's in the bond market right now, guys. Yeah, bad joke, but it's no joke. There's really no liquidity out there. Today's data, yesterday's data, central bank commentary should not have moved the bond market the way it did. Vigilantes or not, there is no, and I repeat, no liquidity in the market. So any trends are exaggerated. So we could see the 10 years pop to 250 on Friday. We could see it drop back to 220 or 210. Your guess is as good as ours, but we think it's going to be a one step back, 2 steps forward, 1 step back. And when the Fed starts tightening, it kind of arrests things, and we're going to get a flat curve probably by 2017 in a very, very modest fashion, maybe even early 2018. So already they're calling, swap out of bonds for stocks. One guy in CNBC says, I consider stocks an alternative to bonds. Oh, yeah, I consider my race car as an alternative to my wife's family car. Right. Okay, that makes a lot of sense. Good luck. Good luck driving on the highway with the race tires. See how long they last, right? The apples and oranges, they're not the same thing. So we think the great rotation is dead, and we think that the demand for income is going to be strong, and that brings us to 2 more points. For years, the sleeve guys, the model guys, the prefab models that consist mostly of mutual funds have gone out and said, buy junk bonds. They do well when rates rise. They do well when the Fed tightens. They've done well when the Fed tightens. The problem is when the Fed is tightened, rates did not go back to where they were the previous cycle in most cases during the last 30 years. And that's, by the way, that's really the true life of the junk bond market. In the early to mid 80s, remember Drexel Burnham and those folks? They were the first junk bond kings. So we had it on today's Making Sense report. But if you look at a chart of interest rates, they go like this. So even when the Fed tightens, it didn't go back to what was before, and we had these junk-rated companies refinancing at the same and sometimes lower rates than where they financed some of their debt in the previous cycle. Now, as again Jeff Gundlach points out now, and we've written about for 3 years, yes, 3 years since 2012, all right, that we have a situation where these junk-rated companies are probably going to have to refinance at higher rates with revenues that have gone up a lot less. And at the same time, you're going to get another whammy here. You have investors who were seeking yield and went into junk debt, either directly or indirectly, because they had to for yield purposes, not because they wanted to. If they can go get 5% in an A-rated bond, they might not want 6% even, or definitely want 5%, maybe even 7% in a B-rated bond. They might say, for me to take that kind of a credit risk, especially when your defaults start creeping up, I want 8%, I want 9%. These companies who are still B-rated and triple C-rated with financing around 5, they're going to say, I can't afford that. Here's what we do. We're going to default, or we're going to work you out at 75 or 60 or 50 cents on the dollar, a new bond and stock will make you whole that way. And investors go, well, what happened? I supposed to get this 5-6% to maturity. Now they're not going to mature at par. And I had this fund. The fund manager supposed to pick the best of the collateral, best of the bonds out, and they're not paying at par. So we think that junk bonds will underperform investment grade over the long term. Yeah, there'll be blips and volatility, but remember, volatility on a bond is unrealized, profit or loss. When something defaults, it's realized, and you have that loss. So again, our high yield exposure, even for our risky accounts, tend to be in the double B range. Get as high as you're comfortable being credit quality wise, up to about mid-single A. We think the sweet spot here is low double B to mid single A in corporates. In munis, single A. It is a no-brainer. You have pre-tax yield around the same yields as similarly rated corporate bonds, except an A-rated muni has similar credit risk as a double A-rated corporate. And now we're starting to see investors panic again. Oh my God, it's Puerto Rico. Oh my God, rates are going up. Let them hang themselves. Don't be one of them. You know, there's a lot of bad information. There are a lot of unknowledgeable people out there. Don't fall into that trap. You know why you own what you own and know what you own. You know, so that pretty much sums up where we stand on interest rates. Remember, long-term interest rates eventually reflect inflation pressures. I'm sorry, guys. You have a 1.2% core PCE. That's the inflation rate the Fed looks at when it wants to be sure inflation moving back towards the 2% trend. At the earliest, we think, and it's still a base case, but it's still really at the earliest, we think we see a Fed funds rate hike is September. There's just not going to be enough inflation. There's not going to be enough wage growth. We think we're lucky if we see 2.3% wage growth this Friday. It might even be back to 2.1. We don't see it. The Fed's beige book for that was released today indicates the economy is only growing moderately. Some regions even reported declines. Layoffs picked up and wages only grew, I'm going to quote the Fed, slightly. The economy is rebounding from the winter, but it's not roaring back. All right? If this is the rebound, it's not much of a rebound. So, granted, they might, with new methodology, move Q1 GDP higher from its minus 0.7% when they take some of the seasonality flaws, if you will, out of it. But what is that going to do to Q2? It's there's this sentiment out there among pundits that only Q1s are bad, but the rest of them are okay. Can't have your cake and eat it too, folks. If seasonality is wrong, seasonality is wrong. And it's probably borrowing from other quarters. How much and from what quarters, that's yet to be determined, and it's not a perfect science. It's an art. It's why algorithms, as far as trying to predict overall trends, break down when correlations change. And that's what's break. Even Fed Chair, Boston Fed President Rosengren said that the current economic models at the Fed aren't taking into account changing consumer behavior. Consumer behavior is changing, technology is changing, demographics are changing. You can't say, all right, this is what happens, fire and forget. So good luck with your robo platforms, because those correlations that perform so well during the baby boom years, and then when the baby boomers were at peak earning years, might not perform all that well going forward. And that's a mistake. And the bond guys seem to be on top of this. Both the bond fund guys and the bond trader guys and the bond strategists. It's the sleeve dudes out there who say, yes, our asset allocation model says that you should own 20% in bonds. Oops, we have to make an allocation change. You should own 15% in bonds because our model says so. Pay no attention to what's going on behind the curtain. That's going to blow up on in your face, we think, down the road. So pay very close attention to the markets, but don't get rattled. Know why things are happening. Stay in touch with us. Call us. Watch our videos. Read our reports. Subscribe. We have a shop to fund here. Just kidding. We shop. The shop's funded pretty well, but stay in touch with us. We'll hold your hand. Don't panic out there. We have almost 3 decades of fixed income experience here. So some of the modelers out there haven't been alive for 3 decades. Okay, hang with us. We'll go get through this together, and there'll probably be opportunities down the road. All right, and please do not use equity research and strategy for fixed income investing. Apples and oranges. It's like me trying to judge my race car there on its snow capabilities. Not a good thing. So anyway, it's 8:30. It's been a half hour. Call us during market hours, 570-424-1555. Email me, thomas.byrne, that's BYRNE, at WS, that's Whiskey Sam, the word and, A-N-D, the letter M, so WSandM.com. Follow us on Twitter. We have over 370 followers now. We're doing something right. It's at Bond-Squad. I'm sorry, at Bond, I think _. You'll find us at Bond Squad. We're up there. We're the only ones. You'll find us up there. But we have a good following up there. Retweeted a lot. Some pretty interesting people follow us. So hang with us. We try to send out tweets during the day to try to keep everybody current on what we're seeing and trying to debunk some of the theories. So we're out there. We're not shy. We'll tell you how it is. And have a good night. If you're ever in Northeast PA and you want to visit our shop here and want to talk bonds, we're in Jonas, Pennsylvania. Our office is in Stroudsburg, 907 Main Street. If you want to talk bonds, we don't talk cars much there or bikes. But stop by. We're down to earth. We know what we're doing. And we love what we do. And with that, have a great night. Goodbye.